Rahatsızsınız inşallah. How's the exposure on this one? How's the exposure on this one?
very friendly. Good morning to the launch or the pre-conference of Everest Wealth's announcement of them joining the Cape Town. And we're close to one of the wonders of the world. So today is really a great opportunity for us to share the new announcement, also what this holds for Everest as a company, as well as the investors, and going forward into the future as one of the leaders in their sector. So my name is Saya. I will be the program director. Thank you so much for coming from far and wide. Our members of the media is joining us here today, but also via the link. There's a lot of them, also from Johannesburg and Pretoria, Gauteng, who cannot be here. But thank you so much for joining. It's a great opportunity to share this amazing story, to show that the economy is still growing. There's a lot of dynamic innovation and also dynamic opportunities out there for companies like Everest Wealth, and it's a great opportunity for me and a great privilege to introduce Thijs van Zyl, who is the founder of Everest Wealth, that will give us an overview of what today is about.
Thank you, Saya. Yeah, so Jared, this has been a dream of ours for the last upcoming 6-7 years when we started off Everest back in COVID. So the entire story started when we said to ourselves, let's do this, let's take private equity into the public sector, and let's not just give this into institutional capital, and let's just create a portfolio that can actually be outcome based instead of being priced and volatile on a daily basis. And I think that also came from both of our experiences being in the financial markets for more than 20 years. If there's one thing that most clients complain about or dislike, is volatility and when you actually lose money. I think that's the most two important factors when it comes to investing overall. And then of course there's that space about creating something out of nothing, and I think that's also that basically justifies what we do and all the other private equity structures out there, is to start building something from absolutely nothing. And I think down the road, it's been now 7 or 8 years with Everest and 10 years with Laudian Group, and I think we've done quite well comparing the spaces that we've been in. But let's just quickly have a look in an oversight of physically what has happened over the last 30 years when it comes to the South African economy, and also when it comes to listed type of instruments. So the JSE over the last 30 years is no secret that they are the #1 pioneering exchange in Africa. And there was a good reason for that. The platform it's working. I mean, the tech is there, the investors, the institutional capital, the clients, the man and public, pension funds, everybody is stimulating what seems to be, one of the best things since ice cream, if I want to put it in that way. I don't even know why I said ice cream, but it just makes sense in this way, because if you don't eat it immediately, what happens? It melts. So that is more or less the same when it comes to listed stocks. If you don't buy it immediately, it melts in a big sense of way, especially when it comes to the JSE. And the stat I want to actually throw out there is that about 65% of the JSE's volume is based on 10 companies on the JSE. So that's the one. There's a very big success story behind the JSE, but there's a big factor that plays a big role. And that is 10 companies physically, 65% of the volume is on the JSE. And then to put a little bit more salt on that is that the most of the earnings earned on the JSE companies is offshore. So that just physically places something that a lot of clients don't really know, that the JSE is not the factor of the economy or the milestone or even the template that you want to use or associate with the South African economy. And that's why this type of instruments is very, very, very important. So even if you have a look at some major downfalls that we've seen over the last 50 years, just to bring into perspective, 98, the Asian crisis, the dot-com crisis in 2000, the global financial crisis in 2008, where 40% of global stocks was just wiped off. COVID-19, let's not even go back there in 2020, when 35% drawdown was done within weeks. And that's something that we actually experienced now over the last month. If we have a look at the markets as it's performing, there's about a 13-14% loss just over the last 30 days. But that doesn't say that you have to go and panic, because even if you have to look back at 2008, the one thing that you should have done was to keep your stocks, and you should have actually bought more. I think it would have worked out for you by now, but most of the time, what happens is due to volatility, you dump and you sell your stocks. And because many times it can be because of advice that you received, maybe your neighbor, maybe your bridesmaid's friend, or maybe even your hairdresser tells you that the world's coming to an end, and then you get rid of all of your stocks, obviously. So the decline of listings, rise on private markets, if you even have a look at the last 50 years, there's been about 600 companies on the JSE that was actually, what raised on, and now there's about less than 280 left. So it shows you there's a very big decline when it comes also to new listings, also keeping in mind that 65% of JSE listed companies is the top 10, basically. So it just shows you, when it comes to the JSE, there's nothing wrong with the JSE. There's a lot of volume there, 20 trillion to speak about. And even if you have a look at the last 50 years return, it was in the region of about, compounded returns was about 13 to 14%. The last 20 years it declined to about 12 to 11%. And then on the last 10 years was in the region of about 10 to 11%. So systematically it does decline. Okay, but as soon as you get to a bottom load of where government bonds basically exceeds what a listed type of environment can give you, that opens up a lot of opportunities and a lot of ideas when it comes to private debt and structures, outcome-based type of solutions. So the one thing that we physically did learn over the last 10 years specifically is then discipline beats timing, income matters, diversification matters, and then most importantly, a structure reduces risk. And I think that's the most important factor, and that's what we're trying to achieve within Everest. We're trying to create portfolios that's outcome-based rather than volatile and sensitive, and can occur losses when it comes to income. All right, so now I want to give over to Jared Gilmer, the Group CEO, to come and announce what we are all here for. Thank you.
There we go. Good morning, everyone, ladies and gentlemen. I have to say, in preparation of this presentation, this media release, I was quite excited. And first of all, I want to thank you for making the time, and I hope whilst you're here, you'll share that excitement with me. And the excitement is not just because of the exciting news that we want to actually bring out today. It's because there's a new step of the journey for Everest Wealth. Events like this is just the first of many for 2026, as well as first of many for many years to come. And the journey that I want to relate to you today before we go into the exciting news is why that journey is important. And that journey is to make sure that we more frequently engage and share not just with our investors, our clients, our financial advisors, but the media and public, and give them an idea on a continuous basis what the journey is that lies ahead for Everest Wealth. So thank you for joining. And talking about journeys, it's quite interesting. Every journey has a start, and I think Thijs mentioned it quite well. Our journey was a difficult start, a new start, and we've persevered. And it took about 7 to 10 years for Everest Wealth to establish the business that we have today, which we're quite proud is a good role player and a specific role player in alternative investments. And this positioning took time. It took energy, it took resources, it took the development of skills, knowledge, expertise. It took a lot of hits and a lot of misses. Not every hit was a home run, but we're proud that we feel we've established ourselves as a material role player and someone that clients and a business that clients look at for advice when it comes to alternative investments. However, there's a new asset class called private credit. And although Everest has instilled itself in alternative investments, that is a sphere that we've not yet kind of headed into. And if you look at the past year, Thijs mentioned it well, there's been serious planning, there's been serious strategizing in terms of how do we now transition and expand our business into private credit. And it's kind of a natural evolution of Everest growth, of Everest innovation, as well as continuing to be considered not only an alternative manager, but a holistic alternative investment manager. A good example, if we look at the JSE, if we look at Cape Town Exchange and a lot of the alternative exchanges, a lot of our peers, such as APSA, Investec and Discovery, just to name a few, have already ventured into this sphere actually in years that have passed. But the one thing that Everest decided to do in this position is to always be different and take traditional credit markets, and as we always want to do, overlay our own unique philosophy, investment methodology, structure, and opportunity selection. So that's very, very important to us. So the result is I'm quite proud to announce today that we have officially established, after a lot of hard work, Everest Credit Partners, which is our credit investment vehicle that had obtained approval on 5 March of this year as an applicable issuer on the Cape Town Stock Exchange for DMTNs. I'd love to pause for those of us here. I think that deserves a bit of a round of applause. And it was a twofold decision for Everest. It wasn't only to create this asset class for our clients and this opportunity, but it's also the new methodology that we have, that we want to be far more transparent, and we want to make sure that info is far more publicly available to our investors and the public at large. Now, a lot of people asked us on this journey, the experts that we engaged with and clients and distribution teams and the networking we had to do, how do you enter a new sphere? And I said, well, you need a clear plan, strategy, and roadmap. That should seem obvious. And for Everest, that focus is not only on responsible investment decisions, like we have in all our portfolios, but ensuring that investor uptake, adoption, and participation is met with a phased approach. It's very important because the result of a phased approach is you maintain a robust risk mitigation and opportunity selection that you can control whilst clients enter this new ecosystem that Everest Wealth is building. Now, the very big news is that we were approved for 20 billion rand, and with that target, we have a firm belief that we'll very easily obtain, and we won't change that target. However, we will be applying a staggered approach. In coming weeks, we will be launching the first 200 million that will be available to public to invest, and every 4 months, we will incrementally increase that 200 million with the desire over 5 years to meet our 20 billion rand benchmark. Now, applying capital raising also needs its own strategy. And when sufficient investment opportunities present themselves, that's when you want to deploy capital. And that's exactly the same approach that we wanted to have, that we applied in our private equity successfully, and we wanted to replicate that in our private credit portfolios. And the core philosophy there is to be a business led not in investment inflows in isolation to a clearly managed investment strategy. That is critical. Now, part of this planning was an interesting question. You enter as a business and an investment manager into a new sphere. How do you acquire the expertise, skill, and knowledge that you'll need to make sure that that functions well and functions responsibly? And the question was, do we insource? Do we outsource? Do we co-source? Do we partner? And I'm quite proud to say our decision was all of the above. But with that comes a systematic integration plan. And what we've done is we are about to sign a new partnership with a bot partner, and I'll explain to you in a moment what that means, with current role players who already have the expertise, skill, and knowledge in private credit investing, who are willing to transfer that knowledge and skill and overlay our methodology of what our investors need. So we'll build, operate, and transfer over a 3-year period. Year one, credit investments will be managed externally and independently. Year two, they'll be co-managed with external support. And in year three, they'll be managed with external and independent oversight. And from year four, we're confident that we will be, as Everest Credit Partners and Everest Wealth, really well poised and positioned to manage internal private credit investments. Now, this approach might seem strange to some. And in terms of preparing for this presentation, I thought of a lot of the success stories that we've had with other South African financial service companies, and Discovery Health actually came to mind. And I thought it would resonate with everyone why we chose this approach. I don't know if everyone knows that Discovery Health, when they started, for 5 years plus, in the early days, were actually administered by the Momentum Group. Only thereafter, when they learned what they needed to, where they understood what they needed to, did they become the very successful and robust health provider that they are now. So a build, operate, transfer model made sense for us. Now, very important, we spoke about a 3-year journey. What does it mean in year 4? Important to Everest has always been that alternative investments, whether past, present, or future, always need a diversified approach. That was always our firm belief. And what that means is the assurance that a solution or solutions we offer are designed, developed, executed, and managed, always with a retail public investor in mind. Those are the most difficult investors that you will have, that rely on their funds and need responsible investing. If we design our model around them, all other investment decisions become easy. And giving all investors, very importantly, specifically in South Africa, that tends to be behind the global curve when it comes to alternatives, is every single retail client deserves the opportunity to have a part in their portfolio of an alternative investment strategy, regardless of the investment size. That's, again, a firm belief of Everest Wealth. Now, our private credit investment offering will adopt the same strategy, but very importantly, it will not be a one-size-fits-all. That was critical to us. But rather a diversified strategy steering away from concentration risk and opportunity selection, but rather always our North Star, the ability to balance investor return expectation with clear, transparent and blended opportunity selection. Now, what that means or translates to is being an investor-driven business always, and not an opportunity-driven. And that's kind of philosophy we'll maintain. Now, to achieve this, we will try and be agnostic to jurisdiction and sector. And our core focus is going to be entering private credit opportunities, not targeting the highest returns, but investment opportunities that can add additional securities to investors in their capital. And as part of our investment philosophy, higher returns at a higher risk will be a lot smaller part. I want to thank you. I hope that I've been able to share a little bit about not just the good news, the exciting news, the philosophy behind why we want to do what we do and expand and evolve, how we want to manage and how we want to make responsible investment decisions. And with that, I also have the privilege of introducing and handing over to Eugene Boyson. He's the CEO of Cape Town Stock Exchange. And I'd love for Eugene to share some insights and also why Everest and I think a lot of new role players in the investment industry are considering Cape Town as a well-poised destination for alternative investments. So thank you. Eugene, over to you.
Can you all hear me? Perfect. Don't speak too loud. I like to walk around when I'm speaking. I find it a little bit easier and it settles my nerves. But I thought I'd start it with a little bit of a story around the Cape Town Stock Exchange, how we came into existence and why. Can you hear me? Did it go off? So in 1901 and 1902, during the Anglo-Boer War, I was told by Alan Wendy that the Cape Town had its own stock exchange. And it was called the Cape Town Stock Exchange. So we went and did some research on it and thought to ourselves, we couldn't find anything in any of the history books. And about 5 years ago, I was on a trip up to Barberton, and needless to say, I saw this facade on the outskirts of the town, and on it said Die Kaapse Beurs. And I thought to myself, it can't be. So we went back and we did the research, and needless to say, in 1901 the Anglo-Boer War broke out, and the JSE decided it needed an alternate trading venue for itself, and it hijacked the Kaapse Beurs, and it began to trade during the Anglo-Boer War. Now, it was called the Kaapse Beurs because the Kaapse Berge and the Kaapse Rivier that flows into Barberton. I still haven't had the heart to tell Alan Wendy that they never had an exchange, but they do have one now. But the reason it's important is, in spite of the Anglo-Boer War breaking out, and in spite of the JSE only having been established in 1987, they still found the need to make sure that they had a trading venue during the Boer War. That's the reality, and the importance of it was the importance of the diamond fields, the importance of the gold fields, and making sure that businesses had an access to capital markets. And I think we forget about that when we think about exchanges. We think just about the trading of securities, but it's not really about that. It's about capital transformation. It's about making sure that we can get investments. We can get investments in the hands of the retail public, investment to the public. We can increase the participation rate in the underlying economy. But more importantly, we can get money in the hands of mom and pops businesses, smaller businesses starting out, infrastructure, everything that surrounds us. The origins come from some type of capital transformation play. Now, people often ask me, well, how much can you support in terms of liquidity? What's the numbers you can support in terms of liquidity? That's not actually the important question. The reason exchanges were established was in the early 1700s, they created contractual liquidity. So you didn't have to go through 6 months of negotiations with someone in terms of buying their company or investing in their product. Everything was already on the tin. There's no sale of transfer agreement. You go to your broker and you can buy and sell your security freely. And you know the next day the securities are in your account and the cash is settled. That's the value of an underlying exchange. The exchange takes all the problems away from you in terms of doing the underlying due diligence and insights into the companies that you're investing in. They break that corporate veneer and give you a transparency around what it is you're investing in. The importance of that in terms of the modern economy can't be understated enough. And I think along the way we've lost our North Pole in terms of what they do. Too much of the market has become around high-frequency trading and direct market access. Too little has become around transforming the economy itself, investing in real economy initiatives, investing in real economy assets. We're very proud to have started the exchange with a specific focus on smaller businesses. We are looking to raise money for businesses with 100 million to 2 billion market cap. People say to us, is it profitable? Why do you want to do it? Well, the first reason we did it is because the JSE wasn't there. So we didn't have to wake up every morning and get a blood nose or get a blue eye from trying to compete with a much bigger entity that's been around for 130 years. The second reason we got involved in it is because that's the biggest sector. There are only 100 companies with a market capitalization, closer to the R1 trillion mark. There's probably 55,000 companies that fall into that bracket. A much bigger audience and a much bigger target set to go and reach. A much bigger target set to go shine a light on. So in 2001, we launched debt markets. Currently, the JSE has 800 listed securities on its exchange, 261 equity issuers. Since October 2021, we've now listed 77 debt instruments, and we've listed 18 equity instruments. So it takes us to 93 listed instruments on our market, and a market cap that's already growing steadily and continues to add every year. We'll probably triple our underlying market cap in the next 6 months, and it's all in a sector that they're not playing at. Another thing we forget is, yes, the JSE has a 20 trillion market cap, but when you look at the counters that make up that market cap, none of them listed with a trillion market cap. Naspers listed in 1957. It was a bookshop operating out of Durban. It grew through time. It became the behemoth because of it raising capital in the markets at that point in time. And very similar with some of the smaller mining companies, started out as junior mining companies, listed in the roaring 80s and 90s, and gradually built themselves into the behemoths they are today. So if you can position yourselves with them while they're still in their growth phase, that's what interests people. Do I want to buy a company just if it doesn't have any growth prospects? Do I want to buy a company just so I can exit investors? No, I want to buy something that's selling growth. The people selling growth are those smaller companies. They've got ambitions. They've got ambitions to change the world. They've got ambitions to change product. They've got ambitions to innovate. That's the sector we want to get interested in. It's very easy to get investors excited about a proposition that provides growth. Yeah, it comes with increased risk. People are prepared to entertain that risk, provided they see the commensurate benefit or the commensurate opportunity associated with that risk. Private credit, in terms of where you're going into, is an interesting space. It's another capital transformation mechanism that's gaining traction worldwide. Not just in private credit, private listed, private equity, we're seeing listed venture capital. Why? It's just another mechanism to get the cash in the hands of the companies that sorely need it. We are not going to enhance the capital transformation mechanism or get money into the hands of entrepreneurs if we rely solely on banks. You know who has the risk dynamic? Believe it or not, only retail investors have a risk dynamic. Not institutions, not asset managers, only retail investors. If you wanted to start a company tomorrow, who do you think would be the first person who funds you? It's probably going to be your parents. And then maybe it's going to be your brother and sister. Then it's going to be friends and family. And maybe 3 years down the line, the bank's going to give you a revolving credit facility. The risk dynamic sits in the retail investors out there. They're the ones who understand it best. And trust me, they really do understand it. They understand the risks associated with it, and more importantly, they're the only ones who understand you and how you sell that. So for us, the Cape Town Stock Exchange became that expression of interest where these smaller companies could express themselves and reach the public. So we've always looked for clients who've aligned with that underlying process. We've always looked for clients who've aligned with that underlying values construct. And many of the companies that did list embraced entirely that. And we've seen underlying cooperatives list, we've seen underlying infrastructure listings, we've seen sophisticated structures that have been catered for the retail public. All of those have been done to de-risk the proposition on behalf of the retail public. And in terms of it, we've seen an increase in the participation rate. We started off with very low levels of liquidity, and gradually those levels of liquidity are increasing. And it's only due to the quality of the investments, and it's the quality of the interest from the public. So if I had to ask you what's the single biggest thing we could change in the landscape in South Africa, there's actually 3 markets that have been growing the fastest in the world. And everyone's first inclination is to think that growth is happening in the US or it's happening in Europe. But actually the 3 markets that are growing fastest at the moment are Russia, in spite of sanctions. So the MOEX exchange added 44 million retail investors. It's the Indian Stock Exchange, added 120 million retail investors. And it's Kazakhstan has added 4.5 million retail investors. All the growth has been in the participation rate due to the inclusion of retail investors. Right now in the Indian exchange, 41% of the market turnover is driven by retail investors, not institutional. In Kazakhstan, it's 61%, and in Moscow, it's 44%. And that's in less than 3 years. So how do we shift South Africa? When we talk about participation at the bottom of the pyramid, we're talking about increasing the participation rate in the economy. And if you want the capital transformation to happen, that's how you increase the participation rate. By getting more and more retail investors involved in the decisions that move the economy forward. So I'm gonna leave it there and just say, Jared Tace, thanks for choosing us as your destination to launch your listing. I can rest assured we're going to be around with you for a long time. CTSE was established already 9 years ago, so we're finally beginning to reap the benefits of that 9-year overnight success. But yeah, we'll be around for definitely another 9, and hopefully like the JSE for another 130. Thank you.
Thank you very much, gentlemen. As mentioned, we've got a number of media houses that were not able to join us today, but they've sent in some of the questions. So I'm going to ask questions from 2 media houses that have sent it to me online. And then if any of you have questions, we can also take those. Thijs and Jared, you can decide which one to answer. The first one is from Vanessa Banton. She's News 24. And I know that you touched on it briefly, but why Cape Town Stock Exchange and not Johannesburg Stock Exchange? Why they made that decision?
No, thank you for the question. And it's touching on what Eugene mentioned. When we started our business, we had the exact same philosophy. We said to ourselves, there's this weird disconnect where people want to invest, retail investors, and they feel where they invest needs to be the same place that they live. And it was a weird, it didn't make sense. And over many years, it now made sense, is if you want to live where you invest, you need to invest where you live. So that would be my answer to it. We share Eugene's view. We want to change South Africa. If we had to go globally, we want to have the same dynamic of breaching that gap of where you invest should be where you stimulate where you live.
Great. And then the other question is from Tsepo Mwai. He's from the SABC economics editor. He found it very interesting, the bot model. Is that, if you can just explain a little bit more about that, how you determine your investor portfolio, is it AI, how does that work, and how reliable that it is, and are you the only company using that, or is that a standard practice? It's just a little bit more information around that.
No, again, thank you for the question. I'll say this, and I say it under correction, because I've not seen the same model applied elsewhere. But in simplistic terms, when you enter a new sphere, it's like you want to become a specialist, and you've been a GP, you want to become a cardiovascular surgeon. You kind of need to go under a mentorship, you need to go training, you need to do your rounds in the hospital, and we said if we want to responsibly enter this market, we need to rely on current expertise that could transition from being outside of our business internal to the business. So no, it doesn't change the process, it's a talent acquisition and a drive to have a responsible team at the end of 3 years that internally manage the business.
Thank you very much. Any other questions from the floor? Otherwise, we're going to mingle, and you can ask your questions one-on-one to Jared, Thijs, and also Eugene. Thank you. Thank you very, very much, everyone, for coming. Enjoy the Cape Town weather. There will be drinks. There will be something to eat. Travel safely home. We'll also be able to send out the photos. I know some of you have asked for the photos. There is a live link. I'll also get the recording of that so that we can send it out to the rest of the media pack or those wanting it. But thank you so much, and have a great day.